Hello, welcome back to the Macro Gamer channel. My name is Mark Hassingham, and we're going through week 2 of our portfolio numbers. This is our ROI, or our return on investment. So this is a long-term, month-by-month, year-by-year portfolio strategy using diversification and allocating to 6 different asset classes. So stocks, bonds, gold, commodities, US currency, and Bitcoin. So we're going to go over that portfolio. So this is for week August 3rd, 2024. So as of today, our portfolio net worth, we're at $99.20. And you can see our pie chart so you can get an idea of our allocations. This is our weekly data for week 2. So you see you have our portfolio curve here. We had a spike in the middle here, July 31st, around August 1st, and then it came down. There was some volatility on Thursday and Friday. I'm going to show you that in some of the charts, which was very interesting. We're going to go over those numbers as well. You see on the bottom right here, you have our money weighted return down 0.37%. So you have a negative market gain of 11 cents, so down 0.11. So that's our week 2. Compare that to our week 1, we had more of a flat line because we just barely started in July 2022. So there wasn't much change in the market. So it was a more steady week. And we were down 0.21%, or a market loss of 0.21 cents. So this is week 2 versus the previous week 1. Our week 2 percentages. So gold is up 2.09%, or 62 cents. Government bonds, you see here last week we were at 10%. We actually increased it, we doubled it to 20%, and it is up 2.53%, or 0.41 cents. There's a big move in bonds, we'll go over that. US dollars, or UUP, still at 20%. We're down 0.85% this week. We're down 0.17 cents. Our commodities, which was originally 25% of our portfolio, now it's down to 15%. So we reduced this by 10%, and we increased our government bonds by that 10%. So we just moved the money from one to the other. So US commodities were down 1.75% this week, or 0.33 cents. Stocks at our 10% allocation is down 1.91%, almost 2% in 1 week, or down 19%. And Bitcoin, our most volatile asset, is down 14.23%, or down 71 cents. Of course, this is only 5%. This is our smallest allocation. So it's a pretty big week for a lot of these assets, really. Gold, bonds, commodities, stocks, even Bitcoin just had like close to big number changes. 2%, 1 to 2% in a week is a pretty big change for a lot of these assets. Bitcoin is volatile. It's always a high number. But these other ones usually move a little more slowly. You see these numbers change so drastically, it shows it was a volatile week. So if we compare that to week 1's numbers, we were down 0.4%, gold 0.5%, USCI, commodities, dollars 0.05%, RSP 0.4%, government bonds 0.2%, or Bitcoin 0.2%. So it was much tamer last week than it was this week we just went through. And also, like I said, you see last week bonds were at 25%. I'm sorry, commodities were at 25%. And bonds here at government were at 10%. So remember that 10% came out of the USCI, the commodities ETF, and went into the government ETF. So now this is at 15%, our commodities, and 20% is our allocation now for government. You can see that here. So there's a big move. It was timed pretty well, not by my calculation. I just wanted to make that change as I was talking about the previous week. It just so coincided with a volatile week this week. So we'll go over those in the charts. Here are those transactions. So on July 31st, I had, that's when I did the rebalance. So I took 10% out of commodities, put it into government bonds. So you see I had one buy. You had government bonds, $9.91, and you had 3 sells. The RSP, the stocks, and the gold were total less than $1, 0.18 cents, 0.34 cents. It was the commodities that was the big change. It was 9.61. So $9.61 got sold out of commodities, reducing it by 10%. And government bonds bought $9.91 of the ETF to increase it 10%. So that's the change in that. Now for our Illuvium staking, this is week 2. So again, revenue distribution has not started yet. So we're still waiting on that. We still have our stake in the program. The current price is actually $48.11 around now as we're filming. So our allocation is 1.32 IOV still, the portfolio values there. But like I said, we have not started revenue distribution yet, so we're still waiting for the program. This might take a few weeks, this might take a few months, we don't know yet. We just started this on the channel very recently. So you'll see my vesting. Last time I showed this, it was unlocks in 364 days. So now we're a week later, so now it unlocks in 358 days. It's still that 1.32 IOV, still a weight of 2, and it was staked on July 27. So remember, this is staked for a year. It's like a certificate of deposit from a bank where you give your bank $100. They tell you in 1 year they will give you 5% on your money. So 365 days later, the bank will return you your $100 that you had originally locked up, and they'll give you an additional $5 for that 5% return. So you'll net $105 after 1 year's time. So similarly, you're locking up your money in this staking protocol, but in this case, you're earning revenue from in-game transactions. So every time a gamer buys a skin, a sword, a gun, shards, gems, whatever, you know, a small fraction of that transaction will get paid out to people staking in the program. So I'll get a small transaction of that, and that'll be our passive income. So that's another way we're getting our ROI. The first way is through our M1 Finance portfolio. We'll get our ROI through diversification of our assets, as you see on here. And the second way is we get through the staking program on here. So no revenue distribution yet. Like I said, it's still 0. We're still waiting on that. The game just barely came out July 25th, so there's a lot that still needs to get done, and it's still in beta. But we're prepping ahead of time to, when this game starts, when it starts getting revenue, we can start showing it. So that is the end of the slide deck. So let's go into the charts and let's look at some numbers. So let's start with our largest allocation here, gold. We'll look at it on a 3-month chart, just like last week. So we're still in this upward trend. We'll look at it on a 1-year chart to get a better idea. So you see I put these green lines, and you can move these around. They don't have to be perfect. If some people might want it more like this, where it kind of touches the tops of these lines here, and it makes a little more sense. I don't care as much. I just want it to kind of guide my eyes as I'm looking at it. So I just want to see kind of the overall trend and which way it's going. So we're still in this long uptrend since back here of October 2023. Gold did increase a little bit this week, but you know, like I said, this week was a volatile week. There's a little bit of a sell-off. So we're still our largest allocation, 30% into gold. Our UUP, our dollar index. This is a 1-year chart. You see, remember we had our peak of October 2023. It's been coming down, and you look right here, it broke through this line, and December 2023 started coming up. So when I put these on here, this more recent, let's get a little zoomed in. This recent drop right here, like this just happened. Like this is August 1st, right? This just happened this week. So there's a big drop in the dollar index. Now when I put these up last week, I was saying it could go up or it could go down based on this little wedge pattern that we're in. Well, clearly it went down. So if this trend continues downward, our current allocation to US dollars, which is 20%, I might reduce that. Like I said the previous week, I might come down to 15%. If it gets really bad, I might come down to 10%. So I'm still waiting to see a little bit more information. If I look at it on a 5-year chart, you see we kind of had this big run up since June of 2021. So we're not completely, you know, bottomed or anything like that. We're kind of just going sideways. So I'm just looking to get more data and we'll go from there. If I look at our government bonds, you basically had the reverse happening. So we had this wedge pattern here and you see it shot up. So if I extend out essentially these lines like this, you know, there's going to be this cross point, but if you look what happened, it shot up. And this is what I was talking about. So this is August 1st. Again, this week, it was a very volatile week. So dollar dropped down right here. The US dollar index dropped down and our government bonds went up. So bonds came up. So this is where I got that 2.5% gain in our bonds position. So that was it was, like I said, it was appropriately timed, not because I planned it that way. I talked in the previous week, I wanted to make a change and I did. It just so happened to coincide with the market crashing. Now, I don't know what's going to happen on Monday. I look forward to seeing what's going on, but right now I know volatility is high. So if it continues downward, this bond trade might still continue to do well for us. So if we look at it on a 1-year chart, we'll just see the overall trend was coming up and then it spiked up. But if we look at it on a 5-year chart, remember bonds have been coming down. This trend has been coming down for a while. So this might, air quotes, be a bottoming in bonds, and we might start seeing a reversal and going up. I don't know that for sure. All I'm doing is following the trend lines. So now we have our commodities, our US commodities index. So we look at a 1-year chart, you see this broke through this line right here. So I'm going to extend this green line out a little bit further, just so we kind of like project outwards, just so people can see what I'm talking about. and it was going in this uptrend since December of 23, and it's been heading up, but now it's starting to break down. So I was talking the previous week I might reduce my position, which I did, and you can see why it broke through these lines and started coming down. Now if you look at it on a 5-year chart, you know, bonds have been, commodities have been coming up a lot, mainly due to all the inflation from the pandemic. You see here March 20, April 20, this is right around the beginning of the pandemic. And then we had the money printing, you know, supply chains started getting messed up and everything. So commodities started rising. So it's a really good trade for the past few years. And it's just barely starting to come down now. So this isn't even a big drop. You know, you can still hold this trade for a little bit if you wanted. But if the trend is going south, you know, like I said, I want to reduce the allocation to commodities and I want to put that position somewhere else. In which case, again, we chose bonds. So when that dropped, this came up. So that was a good trade right there. RSP, this is our stocks. So on a 5-year chart, you know, stocks have been going pretty good. It's gone flat. Remember, this is an equal weight index. This isn't the S&P500 where it's heavily allocated in like 7 major companies like Nvidia, Apple, Google, Microsoft, you know, the big tech names. This is more of an equal weight index. And you see right here, there's kind of a drop that happens. So again, if we zoom in a little bit on that, you know, this was again a Thursday and Friday's action. So it's August 1st, August 2nd coming down. This was again a big drop right here. So again, this is the volatility I'm talking about. It was a big trading week this week. So again, our position has not changed. If this gets worse, I might reduce it. But again, over a 5-year chart, we've gone up and we've gone pretty much sideways. So it's not too big of a drop that would come down here. But again, we're going to wait and see. Bitcoin. So on a 1-year chart, you'll see we had this long-term trend and then it came down and we have this long-term trend, and look at this breakdown that's happening right now. So again, this is all happening this week. It's kind of a big week. Let me extend out these lines to kind of give you a better idea. Oh, don't move my chart. There we go. So if I look at it on a 1 month, you'll see it broke down. Right, again, this is July 31st, August 1st. It's all happened this week. You know, it's a big drop. So it was definitely a volatile week. But our Bitcoin allocation is already at its lowest, which is at 5%. As I said previously, none of these assets will ever be zero. That's not the point. That's not diversification. We need 6 different allocations, and we need 6 different percentages in each one that will total 100%. So the lowest, ideally, we're trying to do is 5% for an allocation, and the highest is 30%. Like, so the example I have is gold at 30% and Bitcoin at 5%. I don't want to go beyond 30% because I'm less diversified the more I go into one asset. And I don't want to go to 0 or 1% on any asset because then that's not diversified. I need to have, you know, at least a minimum of 5% in an allocation. And because of Bitcoin's volatility, that's why I keep it at a lower allocation. And this is a good example of why. This is a big drop right here. Now, if we go over kind of why the market's taking, we have our volatility index here, the VIX. So if I look at this on a 5-year chart, I drew these lines previously to kind of just help guide my eyes. But you look here back in February or March of 2020, you'll see this was the pandemic. There's a huge spike in volatility. This is when the market crashed. So if I look at the SPY, this is right here. This is March of 2020. You know, there's a big drop and then followed by a big recovery. So in a previous video, I talked about this where, you know, the market came down due to the volatility, and then in the same year, it hit a V bottom and then started going up. So it was really crazy to see. There's a lot of the money printing, the government, the Treasury, the Federal Reserve, everything was changing, and there's a big spike up in stock prices. But when we look at the volatility, the VIX right now, you'll see it kind of coming down. This is back in 2020, going into 2021, right? So volatility was lowering, and then volatility started rising at 21, 22, and the volatility started lowering at 22 to 23, and now here we are 23 and going 24, and we have another volatility spike. So we look at this at a 1-year chart. I'm just going to extend my lines a little further just to show that clean break. And I have these horizontal lines on because typically, if I hit this all button, this volatility index goes back to about the 90s, early 90s looks like, and then it continues on. And it doesn't go much below 10. So you see this lower line here. The volatility doesn't go much below 10. Right? That's kind of like the low end of volatility. So this isn't an index chart that goes to 0. It's just when there's not a lot of trading activity, the volatility goes lower. And the average volatility is somewhere between 10 and 20. You see a lot of like low volatility here, then you see these huge spikes that come up once it gets above 20. These huge spikes. right? So I'm always looking for that. Like whenever it gets above 20, these huge spikes that come up, and this is a good example. So this is, let's look at it 1 month. So this was Thursdays and Fridays volatility. This is August 1st, August 2nd. This smashed through the 20 VIX. It just came up here. And this is why in correlation, we saw this crash. Well, now we're looking at the S&P 500. Look at this crash that happened. So at the same time, the VIX was spiking up right here. The stock market, the S&P 500 was crashing down. And this is why all the numbers were, 1 to 2% swings. It's very volatile in a week. Another thing to look at is as these are changing, we have our yield curve, our 2-10-year yield curve. And if you don't follow the yield curve, I don't blame you. Most people don't, but basically, whenever you take out a bond, you have different durations: 1 year, 5 year, 10 year, 20 year, 30 year. Typically, the longer you go out, the higher percentage return you get on your bond. So as an example, a 1-year bond might pay you 5% for 1 year. A 5-year bond might pay you 7%. So you get 7% annually, but per year adds up. 10-year bond, maybe you get 10% or something. Like the longer you lock up your money, the greater percentage return you have. That's a typical normal functioning market. If it's ever reversed and the short term is higher than the long term, then usually people in the market are scared or they're speculative that they don't think things are going to be good long term. So whenever you see an inversion below zero of this number, that's usually an indicator of a bad sign or recessions to come. So this, as an example, is a 210 yield curve, and this goes back to 1976. So anytime you see this low drop in here, these are volatile times. So this is from the 70s to the 80s. You see volatility here, and then you see above the zero, which is more normal rates, and then you see volatility here again. This is the 80s, and then you see above, and then you see a low crash in the late 90s, 2000s. So this is like the dot-com bubble right here, and then it went up, and then it came down, and then you see 2007, 2008. So this is the Great Recession. The GFC, Great Financial Crisis. And then you see it go up, then you come down, and then right around here to 2019, 2020, that was the COVID pandemic. It almost flipped, but didn't. But then it came up, and then it crashed. So now we're coming back up, and whenever this spikes up, like this here, or this here, or this here, or this here, it's usually when there's been a recession in the past. So now that we're coming up out of it, we don't know if we're going to break up and smash through the zero line or not. Could happen. Right now, this is a pretty big move right here, but we're just watching to see. But if our allocation to bonds is any indicator, seeing it shoot up 2.5% in 1 week, if this keeps going up, you're going to see that bond percentage keep going up. So we're going to be making money on bonds. Now, if I'm wrong and it maybe comes around here, doesn't quite hit and comes back down, then our bond position will go down and we won't make money on it. So again, we're going to watch this week by week. These are just the numbers. If you have any questions, concerns, criticisms, you can always ask me. I'm just trying to show this week by week. Same strategy, same 6 assets, same market, everything. I don't want to go too off topic, but I see other people have a lot of different, assets in the portfolio. I just want to do my same 6: gold, dollars, bonds, commodities, stocks, and Bitcoin. So that's how we're going to look at the market. So thank you for watching, and I'll see you next week.